Silence fell over trading desks that once roared like engines of money. Billions of dollars in high-yield debt were suddenly radioactive. At the center of the storm stood one man, Michael Milken. He was called the junk bond king, and for a decade, he rewrote the rules of corporate finance. Working from Drexel Burnham Lambert in Beverly Hills and New York, Milken built a machine that funded takeovers, raids, and corporate revolutions. His weapon was not stock, but debt. These were called junk bonds, low credit, high interest, and once considered too dangerous for serious investors. Milken turned them into Wall Street's most powerful fuel. During the 1980s takeover boom, junk bonds financed corporate giants and hostile acquisitions. Companies that banks rejected suddenly found billions available. But the same force that builds empires can also destroy them. And by 1989, the junk bond engine began to stall. Default rates were rising across highly leveraged companies. Investors started asking a dangerous question: what if these bonds don't get paid? The junk bond market depended on confidence and constant new buyers. Once doubt entered the system, the structure weakened fast. Regulators were already circling Drexel Burnham Lambert. Federal investigators suspected insider trading and manipulation networks tied to junk bond deals. Names like Evan Boesky had already fallen in insider trading scandals. Prosecutors now wanted the bigger prize, the financing power behind the deals. Investigators focused on deal networks surrounding leverage buyouts and takeover financing. Drexel's junk bond desk sat at the center of that universe. Then came the legal earthquake. In March 1989, a federal grand jury indicted Michael Milken on 98 counts under racketeering statutes. Charges included securities fraud, insider trading, and conspiracy. Wall Street had never seen anything this large aimed at one financier. The indictment shattered market confidence instantly. Investors feared the junk bond machine depended too heavily on one man. Drexel Burnham Lambert's funding lines began to tighten. Short-term lenders pulled back from exposure. Without steady financing, even powerful banks can suffocate. Liquidity is oxygen in modern finance. Meanwhile, junk bond prices slid across the market. Selling pressure fed more selling. Highly leveraged companies suddenly faced refinancing nightmares. Debt that once rolled forward now hit a wall. Bond buyers demanded higher yields for higher risk. That made new financing brutally expensive. Several junk bond issuers began defaulting publicly. Headlines spread fear faster than facts. Mutual funds holding high-yield debt faced redemption pressure. Investors rushed for the exits. Drexel tried to stabilize the market by supporting prices. But even giants have limits. Losses mounted across positions tied to leverage buyouts. Risk models failed under stress. Confidence, the invisible currency, was vanishing. And without it, markets freeze. Regulators increased pressure on Drexel leadership. Settlement talks began behind closed doors. Legal costs surged into hundreds of millions. Capital cushions shrank dangerously. Clients quietly moved business elsewhere. Reputation damage proved contagious. Inside Drexel, morale deteriorated fast. Top talent prepared exit plans. The junk bond king still fought the charges. But the market no longer waited. The collapse was no longer theoretical. It was unfolding in real time across Wall Street. By late 1989, Drexel Burnham Lambert was fighting on multiple fronts at once. Legal pressure, market losses, and funding withdrawals were closing in together. Federal prosecutors pushed aggressively for cooperation and admissions of wrongdoing. Negotiations between Drexel lawyers and the U.S. government intensified. Drexel agreed to plead guilty to multiple felony counts tied to securities violations. The firm accepted a massive criminal fine to avoid immediate shutdown. The penalty reached approximately $650 million, one of the largest fines ever imposed on a Wall Street firm at that time. The number shocked the financial industry. Even with the settlement, trust did not return. Counterparties still refused to extend enough short-term funding. Drexel's business model depended on continuous market access. Without liquidity, the structure could not survive. Meanwhile, Michael Milken negotiated his own legal outcome. Prosecutors offered reduced charges in exchange for a guilty plea. In April 1990, Milken pleaded guilty to 6 felony counts, including securities fraud and reporting violations. The era's most powerful bond financier formally fell. He later received a prison sentence of 10 years, later reduced, and a lifetime ban from the securities industry. The junk bond king was finished on Wall Street. But Drexel's collapse was not only about one man. The firm itself was running out of cash. Credit rating agencies downgraded Drexel's debt. That downgrade triggered even more funding withdrawals. Large clients began moving accounts away. Prime brokerage relationships quietly ended. Inside Drexel offices, rumors turned into certainty. Bankruptcy planning began behind closed doors. Employees prepared contingency resumes and exit strategies. Recruiters circled remaining talent. The junk bond pipeline froze almost completely. New high-yield issuance nearly stopped. Leveraged buyout firms suddenly lost their primary financing source. Acquisition activity dropped sharply. Companies that depended on junk bond refinancing faced severe stress. Some entered restructuring talks. Market fear fed on itself. Sellers outnumbered buyers across high-yield desks. On February 13, 1990, Drexel Burnham Lambert filed for Chapter 11 bankruptcy protection. It was a historic Wall Street failure. The firm listed billions in liabilities. Confidence in the junk bond ecosystem collapsed further. Thousands of employees lost their jobs within weeks. Careers built during the 1980s boom ended abruptly. Competitor banks absorbed fragments of Drexel's business. But the culture that powered junk bond dominance vanished. Regulators reviewed oversight gaps exposed by the crash. Enforcement priorities shifted toward market abuse. The SEC increased scrutiny on insider networks and deal financing structures. Wall Street entered a more cautious era. Yet the junk bond concept itself did not die. It went into temporary exile. Over time, high-yield debt would return, but under tighter controls and broader participation. The market learned, but did not forget. Milken himself would later re-emerge as a philanthropist after prison. But his Wall Street chapter was permanently closed. The Drexel collapse became a case study in concentrated financial power. One market, one firm, one dominant figure. Risk had been misunderstood as innovation. Leverage had been mistaken for strength. And the crash proved a permanent rule of markets: when liquidity disappears, even giants fall fast. The reckoning was complete. After the Drexel bankruptcy, Wall Street entered a period of forced reflection. The excesses of the 1980s takeover era were suddenly under a harsh spotlight. Regulators began rewriting enforcement priorities around insider trading and deal financing networks. The junk bond era triggered tougher investigative coordination. The Securities and Exchange Commission increased surveillance of trading relationships. Information sharing between agencies expanded. Investment banks also changed internal compliance structures. Risk controls became more formalized and documented. The phrase high-yield bond slowly replaced the stigma term junk bond. Language shifted to rebuild investor trust. New players entered the high-yield market with more diversified distribution. No single firm would dominate like Drexel again. Institutional investors demanded stronger disclosure standards. Covenant protections became more important in bond contracts. Leveraged buyouts did not disappear, but financing structures evolved. More equity and less extreme leverage became common. Some 1980s takeover icons faded from prominence after the crash. Others adapted to the new regulatory climate. Michael Milken served prison time after sentencing in 1990. His sentence was later reduced for cooperation and good behavior. After release, Milken shifted toward medical philanthropy and research funding. His post-Wall Street legacy took a different direction. Drexel Burnham Lambert, however, never returned. The brand disappeared from global finance permanently. Business schools began teaching the Drexel case as a warning. Concentrated market power became a key risk lesson. Scholars debated whether junk bonds were dangerous or simply misused. The answer depended on discipline and transparency. History showed that high-yield debt itself was not the villain. Systemic overconfidence was. Markets repeatedly cycled between fear and innovation. The junk bond crash marked one of those turning points. The late 1980s proved how fast financial engineering can outrun oversight. Regulation almost always arrives after the damage. Liquidity risk became a central teaching point after Drexel's fall. Funding fragility entered mainstream risk models. Modern high-yield markets are now broader and more transparent. Participation is more diversified across institutions. But echoes of 1989 still appear whenever leverage builds too quickly. Veteran investors remember the warning signs. The Drexel collapse proved reputations can evaporate faster than capital. Trust once broken is expensive to rebuild. Wall Street innovation never stopped, it only changed form. New products replaced old structures. Each generation believes it has mastered risk. History repeatedly disagrees. The junk bond crash remains one of the clearest lessons in leverage discipline. Borrowed money always carries hidden clocks. Drexel Burnham Lambert rose faster than almost any bank of its era. Its fall was just as fast. Michael Milken reshaped corporate finance permanently. Even critics admit the market never looked the same afterward. The junk bond revolution financed growth, excess, and collapse all at once. It was both innovation and warning. Financial history rarely produces pure heroes or villains. It produces consequences. And the Drexel story still echoes whenever markets chase yield without restraint. The pattern is timeless. When risk is mispriced and leverage is worshipped, collapse becomes inevitable. And Wall Street always remembers, eventually.